There is no single good cap rate. It depends entirely on where you are buying and what you are buying. Here is how cap rates break down across the US. Coastal and high demand markets. 3 to 5% cap rates. San Francisco, New York City, Los Angeles, Miami, Boston, Seattle. These markets trade at low cap rates because investors accept lower current yields in exchange for strong appreciation and tenant demand. A 4% cap rate on a $500,000 condo in Miami means $20,000 a year in Noe. Not exciting for cash flow, but if the property appreciates 5 to 7% per year, total return is solid. Growth markets, 5 to 7% cap rates. Austin, Nashville, Raleigh, Charlotte, Phoenix, Tampa, Denver. These are the middle ground. Reasonable cash flow and meaningful appreciation. A 6% cap rate in Raleigh on a $250,000 property means $15,000 a year in NOE. With 3 to 5% annual appreciation on top, you are looking at double-digit total returns. Cash flow markets, 7 to 10% cap rates. Memphis, Indianapolis, Cleveland, Birmingham, Kansas City, St. Louis, Detroit. Higher cap rates mean higher current yield but slower or flat appreciation. An 8.5% cap rate in Memphis on $120,000 a property means $10,200 a year in NOE. The cash flow is strong, but the property might be worth $125,000 in 5 years instead of $180,000. Cap rates also vary by property type within the same market. Single-family rentals. Typically 5 to 9% depending on market and condition. Small multifamily, 2 to 4 units. Usually 0.5 to 1% higher cap rate than SFR in the same area because of slightly higher risk and management complexity. Large apartments, 20-plus units, 4 to 7% in most markets. Institutional money compresses cap rates on stabilized complexes. Commercial, retail, office, industrial. Wide range from 5 to 12% depending on tenant quality, lease terms, and location. The relationship between cap rate and risk is critical. Higher cap rates generally mean higher perceived risk. A 10% cap rate property in a rough neighborhood is not a better deal than a 5% cap rate property in a prime location. The market is pricing in higher vacancy, worse tenant quality, more maintenance, and slower appreciation. Cap rate compression happens when money floods into a market. More buyers competing for the same properties pushes prices up and cap rates down. This happened across the Sun Belt from 2020 to 2023. Properties that traded at 7% cap rates in 2019 were selling at 5% by 2022. Cap rate expansion is the opposite. Rising interest rates, reduced buyer demand, or market deterioration pushes cap rates up. This is what happened in many markets in 2023-2024 as interest rates rose. Sellers still wanted 2021 prices, but buyers demanded higher yields, creating a bid-ask spread that froze deal volume. Your target cap rate should align with your strategy. Cash flow investors target 7% plus cap rate markets. Appreciation investors accept 4 to 5% cap rates in growth markets. Most investors land somewhere in the 6 to 8% range, balancing cash flow and growth.